Welcome to this explainer. Right off the bat, we've got to forget those Hollywood myths of Wall Street being some giant chaotic casino just for speculators. In reality, the stock market is the beating heart of modern capital. It's literally the circulatory system of our national economies, pumping the essential nutrients to the organs that build our entire world. So today we're going to pop the hood and see exactly how this massive machine works. Here's our roadmap for today. We're going to logically break this down into 5 parts. The engine of modern capital, how capital actually flows, fueling economic growth, volatility and psychology, and finally, the societal wealth divide. Okay, let's dive right into Section 1, the engine of modern capital, from coffeehouses to global hubs. To really get this, we have to realize that we've completely shifted from economies based purely on physical trade to economies driven by equity ownership. Think about it. Back in 1602, the Dutch East India Company did something absolutely revolutionary. They issued publicly tradable shares to a broad base of investors. Suddenly, ownership was divisible. It was scalable. Then jumped to 1792, and the Buttonwood Agreement birthed what would eventually become the New York Stock Exchange. In the 19th century, the London Stock Exchange did something incredible. It channeled everyday household savings directly into funding massive railways. They literally built the infrastructure of the modern era. And as the system grew, the rules had to adapt, like the creation of the SEC in the US in 1934 or the massive UK Big Bang deregulation in 1986. So, what exactly is this engine doing every single day? Well, it boils down to 4 absolutely crucial functions. First, capital allocation. It funnels money directly from savers to the companies with the highest growth potential. Second, liquidity creation. This is huge because it means you aren't locked in. You can always sell your shares on the secondary market. Third, risk distribution. It takes the massive necessary risks of innovation and spreads them out across a huge base of investors, so no single person takes the whole hit. And finally, corporate governance. Public companies are constantly judged by their share price. This rewards efficiency and heavily penalizes mismanagement, keeping CEOs accountable to the public. Moving right along to Section 2, how capital actually flows, the mechanics of investment. Now, to understand this plumbing, I want you to picture a vast national irrigation system. Let's move to the mechanics and see how this builds. Step 1, it starts with households. Think of us like individual rain barrels collecting surplus income. Step 2, intermediaries, like pension funds or insurance companies, come in and aggregate those scattered, tiny savings into massive reservoirs. Step 3, the stock market steps in as this highly efficient canal network, channeling those massive pools of funds. And finally, Step 4, businesses take that capital and build. They build factories, they invest in new tech, they hire workers, and as they generate profit, that value flows right back to the investors as dividends and rising stock prices. It's this beautiful, continuous conveyor belt, turning your idle money into productive national assets. But here is the catch. This whole network relies entirely on the environment it operates in. Government policy is essentially the weather for our irrigation system. It sets the rules of the game. When governments create predictable policies with clear regulations, investor confidence skyrockets, and the cost of capital actually drops. We saw exactly this when the SEC was created in 1934 to restore trust after the devastation of 1929, or when the 1986 UK Big Bang deregulated London, turning it into a premier global hub. But on the flip side, if policy is inconsistent, watch out. Markets quickly deteriorate into capital flight, speculative chaos, and high inflation risks. Which brings us to Section 3, fueling national economic growth, the connective tissue of prosperity. Because, you see, growth isn't just about what a country produces today. It's about how efficiently it funds future capacity. Deep, liquid markets act as a national-scale matchmaking system between money and ideas. And this isn't just theory. It literally funds industrial miracles. Look at post-World War II Japan. The Tokyo Stock Exchange was the primary engine that took a war-damaged economy and transitioned it into a global powerhouse, financing absolute giants like Toyota and Mitsubishi. Or look at South Korea. Equity financing grew their massive chaebol conglomerates, companies like Samsung, becoming the driving force of their export-driven miracle. In a healthy market, good ideas get funded fast and bad uses of capital get phased out. Let's shift gears to Section 4, volatility and human psychology. When the heart palpitates. We really have to contrast the rational, logical design of this market with the reality that it is a living, breathing network of human expectations. See, stock prices are naturally forward-looking, meaning they are constantly adjusting to new information. That creates standard volatility. But human psychology throws this whole system into overdrive through something called herding behavior. This is what happens when people completely abandon logic just to follow the crowd. It's usually driven by either intense fear or totally boundless optimism. And this psychology dramatically amplifies normal, everyday price swings into extreme peaks and terrifying valleys. History absolutely proves how dangerous human emotions can be when they destabilize an economy. I mean, think about the 1630s tulip mania. People literally traded entire estates for one single flower bulb. No way that makes logical sense, right? Then there's the devastating 1929 stock market crash, the sudden shocking drop of Black Monday in 1987, the 2000 dot-com bubble, and of course, the excessive risk-taking that triggered the 2008 global financial crisis. Now, some volatility is totally required for markets to adjust to reality for sure, but when that herd mentality takes over, those massive emotional swings cause real systemic damage. Finally, let's look at Section 5, the societal wealth divide. Who rides the rising tide? Because beyond all the corporate finance jargon, the market profoundly shapes our social structure and our household wealth. So the crucial point here is understanding the mechanics behind this divide, just looking at the systemic outcomes. Think of the market as a rising tide. The boats out there on the water, those are the equity owners. When the economy grows, they benefit directly from rising asset prices and compounding dividends. They accumulate wealth across generations. But then you have the people standing on the shore. These are wage-dependent households who don't own financial assets. They rely strictly on their labor income. They watch that water rise, but they completely miss out on the compounded market growth. Now, it's true that investing has been democratized a lot recently. Think about pension systems and ETFs. But equity ownership still remains highly concentrated among higher-income households. As highlighted here, this dynamic can seriously widen wealth gaps during periods of strong market performance. Financial literacy isn't just a life hack to get rich. It's absolutely critical for inclusion in the very system that builds generational wealth. Okay, let's zoom all the way out for a second. The market represents a fundamental shift in human history. Money is no longer just a static asset that you lock up in a vault to store value. It's a dynamic force. It's an active energy that continuously constructs the productive capacity of human civilization. The stock market is the heart that pumps this capital exactly to where it's needed most, making sure that our savings today literally build the infrastructure and the innovations of tomorrow. I want to leave you with this provocative thought. If the stock market truly is the heart of our economy, creating such incredible world-changing growth and innovation, how can we ensure its lifeblood reaches every single part of society? Thank you so much for joining me to explore the intricate circulatory system of our national economies. Keep asking questions, keep learning, and I hope this explainer has left you hungry to dive even deeper into the forces that shape our world.